Welcome back to Squeeze Play. U.S. mortgage rates are now at their highest in 6 months. The big question is, will this drive housing prices down? And does it mean more foreclosures are in the offing? Joining us from New York is one of our favorite bloggers and analysts, Yves Smith, the founder of the widely followed blog Naked Capitalism and the author of Econ. Yves, thanks for coming on the show.
Roger, thanks so much. Glad to be here.
Well, I got to look at the numbers today. The 30-year fixed mortgage rose to 4.61%. This is a trend now we're seeing of rising mortgage costs, not because the housing market's recovering, but because mortgage-backed securities are, under some attack here by the proverbial bond vigilantes.
No, well, that's correct. I mean, we've seen some nervousness, all across the yield curve, and it's affecting mortgages as well as treasuries. So the rise in interest rates isn't entirely surprising. And you're correct that really does have the potential to affect higher interest rates mean less housing affordability, means people, will not be able to spend as much per dollar of income on housing if they're looking at buying a house.
And how big a drag do you think this is on the housing sector in the U.S.? Again, some disappointing stats out today. Losses in 2010 on U.S. housing, $1.7 trillion. That's almost $700 million more than 2009 if you compare the two calendar years. So are we in store for another big leg down in housing in the U.S.?
Well, a lot of people said, a lot of people have already been predicting, even before interest rates moved up, a second leg down in housing. Even though some markets, and they're admittedly big markets, some markets look like they've bottomed, like you can argue that, Arizona has bottomed, and possibly parts of California. But the fact is that we still have a tremendous amount of housing inventory that really has not moved on through the foreclosure process onto the market. And anybody who's savvy knows that we've got a lot of, both pent-up sales because of foreclosures that have actually not gone all the way through the process, and therefore that inventory has to hit. We've got the still very weak outlook for employment. That's not so hot. And then you've got the uncertainty about title. I mean, that's starting to worry people, and that's deterring a lot of bottom fishers. So all those factors suggest that, I think a lot of people had hoped that somehow the hocus pocus that the Fed has been doing, that the Treasury has been doing to try to take the air out of the housing bubble gradually would mean that we wouldn't have an overshoot. I mean, I'm not even clear that the market has bottomed, but typically when you've got a big bubble, you have an overshoot on the downside. We haven't even hit the point that you can argue is housing hitting fair levels in terms of historical norms relative to prices and incomes, in a lot of markets. So I think there was a story that you'd see a further drag on housing prices independent of these events that have now got people concerned.
More than a drag, though, people like, we just had Chris Whalen on of Institutional Risk Analytics, and he's actually saying more than a drag that he's seeing there's going to be a new crisis next year, essentially, as a result of the whole foreclosure gate.
No, I think he's 100% right. I mean, this is the view that I've had for some time as well. I mean, Chris and I sort of differ in terms of what you should do about it. But in terms of the basic analysis, you've got a tremendous number of banks that, even with the Fed goosing interest rates so as to make bad assets look better, I mean, low interest rates make all asset prices go up, that they are on their books at unrealistic marks, particularly second mortgages. I mean, a lot of these second mortgages should be written down to zero based on what's happened with housing and the level of foreclosures, and yet the banks are carrying the four biggest banks are carrying their second lien books at marks that are indefensible, and those are so large that alone, writing that down to some more normal level, would have a big hit on the equity of the four biggest banks. So, and then you've got all the sort of other shoes that potentially have yet to drop. So, I mean, I still think you have nobody wants to talk about the fact that we have a bank solvency issue. We have a bank solvency issue, and that chicken is going to come home to roost sometime. And 2011 might be the year.
Well, look, if the analysis is this, you share the same analysis as our previous guest, but a different prescription. What is your prescription for the United States to dig its way out of this? Is it a liquidation of housing? Is it forcing the banks to acknowledge these losses and, get this bad, crappy debt off their books?
Well, where Chris and I agree completely is that we need debt restructuring. I mean, in any other sector of life, when you've got borrowers that are in trouble, the first thing a creditor does is say, okay, let's figure out if the borrower is viable or not. You use the word triage when it's really separating them to two camps. But you say the ones that are just hopeless, we're going to liquidate them. The one who have some level of income, we're keeping them, in this case, in the house, is a better outcome. We're going to cut principal. It's taking half a loaf. Taking half a loaf is always better than taking none. We're going to take a half a loaf and get on with it. And that way, borrowers have discretionary income. They can start spending again. The consequence is the banks take losses. And this whole program has been around, let's wreck the rest of the economy in order to pretend that the banks are okay. I mean, it's a really backwards way of doing things, and that prescription is Japan. And we see how well Japan is doing.
Well, Yves, from your lips to the Obama administration's ears, we will wait with bated breath. But thanks for coming on the show today.
Thanks so much.
That was Yves Smith, the founder of the financial blog Naked Capitalism and author of Econ, a great book. Check it out in bookstores near you.